Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Air Lease Corporation Annual Report. Air Lease Corporation offers a diverse range of services to the aviation industry. At its core, the company engages in aircraft leasing, providing commercial jet aircraft to airlines across various regions worldwide. This includes the Asia-Pacific, Europe, the Middle East, Africa, and the Americas. In addition to leasing, Air Lease Corporation also sells aircraft to third-party investors, including other leasing companies, financial services firms, airlines, and individual investors. This allows the company to expand its reach and generate revenue through multiple channels. The company's services extend beyond just buying and selling aircraft. It also provides fleet management solutions to investors and owners of aircraft portfolios. This involves overseeing the maintenance, operation, and optimization of fleets to ensure maximum efficiency and profitability. With a significant portfolio of owned and managed aircraft, Air Lease Corporation has established itself as a major player in the global aviation industry. Its extensive network and expertise make it an attractive partner for airlines and investors seeking reliable and efficient aircraft solutions. Air Lease Corp's stock price has experienced a significant increase of over 32.79% in the past year, with some reports indicating even higher gains. Several key news events have contributed to this growth. The announcement of a merger agreement between Air Lease Corp and a new Dublin-based holding company owned by Sumitomo Corporation, SMBC Aviation Capital, Apollo, and Brookfield has been a major factor. Shareholders approved the deal on December 18, 2025, with Class A common stockholders set to receive $65 in cash for each share held. Air Lease's strong third quarter 2025 results also played a significant role in boosting investor sentiment. The company reported adjusted earnings of $2.20 per share, surpassing consensus estimates by over 50%, and revenue increased by 15.1% year-over-year to $820.4 million. Additionally, the company's fourth quarter 2025 activity update was positive, with the delivery of 10 new aircraft from its order book and the sale of 23 aircraft to third-party buyers, generating approximately $1 billion in sales proceeds. The delivery of new aircraft, such as the first Boeing 737 aircraft to Air Canada and the Airbus A321 XLR aircraft to Canot Shark, has also contributed to the company's growth. The robust air travel demand and shift towards more fuel-efficient aircraft have led to strong lease rates, high utilization, and revenue growth for Air Lease. The company's young and fuel-efficient fleet is well-positioned to benefit from these industry trends. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Fleet growth has been a significant contributor, leading to increased rental income from operating leases. Higher portfolio yields have also contributed to revenue growth, as well as increased aircraft sales activity. The recovery of Russian fleet write-offs and higher lease rentals have further boosted revenue. On the other hand, revenue decline can be attributed to a decrease in aircraft sales, maintenance rentals, and other receipts. Currency fluctuations have had a minimal impact on revenue growth or decline. Regional analysis reveals that Europe has seen rental revenue growth, while Asia-Pacific and the Middle East and Africa have experienced fluctuations. Looking ahead, the company's commitment to acquiring $12.6 billion worth of new aircraft through 2031 is expected to contribute to future revenue growth. Additionally, the recognition of deferred tax assets of $108.6 million provides a potential source of future income. These drivers highlight the key factors contributing to the company's revenue growth and decline over time. The net income of the company underwent a significant change between 2023 and 2025. In 2024, it decreased from $572.9 million to $372.1 million due to higher interest expense driven by increased composite cost of funds and outstanding debt balance. However, in 2025, it rebounded with a substantial increase of 170% to $1 billion. This growth was largely attributed to the net benefit of $736.4 million from insurance claims settlement and higher revenues. The profit margins also experienced fluctuations during this period. In 2023, the adjusted net income before income taxes margin stood at 7.2%. However, it decreased to 6.1% in 2024 due to higher interest expense. Conversely, in 2025, the adjusted net income before income taxes increased by 25% to $718.4 million, primarily driven by higher total revenues. The reasons behind these changes are largely attributed to the company's financial performance and external factors. The decrease in profit margins in 2024 was mainly due to the increased interest expense resulting from higher composite cost of funds and outstanding debt balance. On the other hand, the net income increase in 2025 can be attributed to the settlement of insurance claims and higher revenues, which partially offset the increases in depreciation expense and interest expense. The company's financial performance indicates a significant milestone. According to the provided information, the company has successfully transitioned into generating positive operating cash flow. This achievement is a testament to the company's ability to manage its finances effectively. A review of pages 49, 51, 60, and 66 confirms this assertion. The data presented in these sections demonstrates a consistent trend of increasing operating cash flow, signaling a strong financial foundation for the company. This positive development has significant implications for the company's future prospects, as it enables investments in growth initiatives, debt repayment, and shareholder returns. The generation of positive operating cash flow is a critical indicator of a company's financial health. It suggests that the business is capable of covering its operational expenses and generating surplus funds, which can be utilized to drive growth and create value for stakeholders. In this case, the company's ability to achieve this milestone is a cause for celebration, as it positions the organization for long-term success. The company's debt level has experienced fluctuations over the past few years. Initially, it increased from $6.8 billion to $7.3 billion between 2024 and 2025. However, this trend was not consistent across all pages, as another report showed a decrease of $0.5 billion in debt level from $20.4 billion to $19.9 billion during the same period. Despite these variations, it is clear that the company's interest expenses have increased significantly over time. The interest expenses rose from $244 million in 2024 to $263 million in 2025, with a notable increase of $53.8 million, 6.4%, between 2024 and 2025. This growth can be attributed to various factors, including higher average costs of funds, aircraft acquisitions, and rapid interest rate increases. The overall trend suggests that the company's debt level has remained relatively stable, while its interest expenses have increased substantially over the past few years. The travel industry has shown mixed results across various regions and segments. On the positive side, the Asia-Pacific region has experienced significant growth, with a 7.1% increase in international travel and a corresponding 7.1% rise in international traffic. This trend is also observed in most other major international markets, which have seen strong expansion. The preservation of the zero-tariff regime in Europe and the UK has further contributed to their growth. In contrast, the US domestic market has struggled, with only a 2.4% increase in global domestic traffic. This sluggish performance stands out as slower than most other markets, indicating a need for improvement in this segment. Overall, while some regions have thrived, others continue to face challenges that must be addressed to achieve sustained growth and success. The management of the company is optimistic about its long-term prospects due to favorable market conditions. They expect strong demand for commercial aircraft, driven by aging fleets and increasing air travel, which will drive demand for their leased planes. To capitalize on this trend, they plan to invest in modern aircraft while maintaining an investment-grade balance sheet. They aim to self-fund their order book using operating cash flows and aircraft sales, reducing the need for external financing. This approach is expected to provide a balanced capital allocation strategy that prioritizes investing in new aircraft, maintaining a strong financial position, and returning excess cash to shareholders through dividends and share repurchases. The company also has liquidity plans in place to ensure sufficient funds are available to meet operating requirements over the next 12 months. They anticipate selling approximately $1.5 billion worth of aircraft in 2026, driven by robust demand in the secondary market. However, they acknowledge potential risks such as delivery delays due to manufacturing issues with Airbus and Boeing, which they plan to manage through revised delivery dates and risk mitigation strategies. Overall, the company's strategy is centered around maintaining a strong financial position, investing in modern aircraft, and returning value to shareholders while navigating industry challenges. The company has made significant acquisitions and divestitures over the past year. In terms of acquisitions, the company purchased a total of 49 new aircraft from Airbus and Boeing during the year ended December 31, 2025. This includes various models such as the A320-100/300, A320/321neo, A330-900neo, 737-8/9 MAX, and 787-9/10. In addition to these purchases, the company has also made commitments for future aircraft deliveries through 2031, with an estimated aggregate commitment of $12.6 billion. This includes specific commitments for aircraft purchases in 2026, 2027, 2028, and 2029, as well as non-refundable deposits on flight equipment purchases. The company has also merged with Sumisho Air Lease Corporation Designated Activity Company, formerly known as Gladiatora Designated Activity Company, on September 1, 2025. Furthermore, the company has acquired a total of 218 new aircraft from Airbus and Boeing for delivery through 2031. On the other hand, the company has made divestitures by selling 48 aircraft during the year ended December 31, 2025. The company also terminated all leasing activities in Russia in March 2022. Additionally, the company plans to sell $1.5 billion worth of aircraft in 2026, as restricted by the merger agreement. The company has a history of paying dividends to its shareholders. As stated in the summary, dividends are paid quarterly in arrears, starting from June 15, 2021, at a rate of 4.65% until June 15, 2026. After this date, the dividend rate will be adjusted to the 5-year U.S. Treasury rate plus 4.076%. The company has also provided specific details on the dividend payments for different classes of stock, including Class A common stock, Series B preferred stock, Series C preferred stock, and Series D preferred stock. However, there is no information available regarding share buybacks by the company. Concerns about inventory buildup or supply chain disruption are mounting in the aircraft industry. Delivery delays and manufacturing flaws have led to strained customer relationships due to missed or late deliveries. Despite a desire to increase production rates, Airbus and Boeing have been hindered by ongoing supply chain constraints. The data suggests that there is potential for inventory buildup. As of December 31, 2025, the estimated aggregate commitment was $12.6 billion, with contractual commitments to purchase 218 new aircraft through 2031. Furthermore, a high percentage of aircraft were leased in 2026, 100%, indicating a risk of inventory buildup if deliveries are delayed. The FAA cap on Boeing's 737 MAX production remains in place, and the broader aviation supply chain is constrained, impacting production capacity for both Airbus and Boeing. These factors contribute to concerns about inventory buildup or supply chain disruption, which could have significant implications for the industry. That concludes the financial summary for Air Lease Corporation. Feel free to comment below, and I will be happy to answer them when possible.